let's get into the whole private credit fiasco, which is going on right now. So at the beginning, again, going back to the beginning of the show, I promised you guys this story here on Blackrock. So Blackrock stung by loans to business accused of breathtaking fraud. So an entrepreneur tapped private credit funds to finance his telecom businesses. Now the lenders say he defrauded them. So BlackRock's private credit investing arm and other lenders are trying to recover hundreds of millions of dollars after falling victim to what they called a breathtaking fraud, marking another breakdown in an opaque corner of the U.S. debt markets. Not so opaque anymore. When it gets to $1.7 trillion, not so opaque anymore. The lenders have accused, and I say this dude's name, but I'm just going to call him Bank Kim. Bank Kim, the owner of little-known telecom services company Broadband Telecom and Bridge Voice, fabricating accounts receivable that were supposed to be used as loan collateral. The lenders filed suit in August. They said this gentleman's companies owe them more than $500 million. Yeah, so this is turning into a major thing. This is just continue to, again, and it gets back into First Brands and Tricolor Holdings. And again, remember what I said last week, the one-offs. They're all these one-offs. It's funny how we keep getting more and more and more one-offs. That's the interesting part here. So, okay. Private lenders aren't out of the doghouse yet. Though not the source of recent defaults, private asset managers still have to overcome investor skepticism. So some recent high-profile bankruptcies have triggered a round of finger-pointing on Wall Street. Private credit giants aren't wrong at the moment to be pointing elsewhere, but investors don't seem to care, and they aren't necessarily wrong either. Neither First Brands nor Tricolor relied on the kinds of private direct lending that is most associated with the private credit giants and their many funds. Last week, Steven Schwartzman, chief executive of private asset leader Blackstone, took the occasion of the firm's quarterly earnings to call to draw a line. These events have been erroneously linked to the traditional private credit market as a result of misunderstandings and misinformation. No. And then down here, we have some of the biggest private credit market players: Blackstone, Ares Management, KKR and Company, Apollo Management, Global Management, Blue Owl Capital. So these are the companies that you're going to see getting dinged with a lot of this stuff here. And this article goes in, I don't want to beat everybody to death, but it basically just goes into how, the private credit market's not that big of a concern. It's just this little opaque market. These guys haven't really had ties to this blow up in the subprime auto industry. Whereas, I'm not buying it. I'm not buying it. And here's another opinion piece. And I think this gentleman, Dan Wertman, he hit the nail right on the head. A private credit winter is coming. Lenders quietly rewrite their collateral rules, which suggest a crisis waiting to happen. Yes. So Wall Street insists credit quality remains strong. At first glance, the numbers back it up. Deal value rose more than 200% in the third quarter. Major banks beat earnings expectations and credit spreads remain tight. Yet beneath the surface, a quiet but dramatic shift is taking place inside credit deals that suggest creditors are bracing for distress and not recovery. Two recent bankruptcies, Tricolor Holdings and First Brands Group, have exposed alleged collateral fraud across multiple major institutions. But they're a symptom of a broader problem, of a deep private credit system with the potential to unravel faster than anyone could track. First, the facts, and it goes into First Brands and Tricolor, and in each case, sophisticated creditors armed with advanced systems and compliance frameworks were blindsided by opaque privately structured financing arrangements and not from obscure fintechs or speculative lenders. They involve JP Morgan, Fifth Third, UBS, and Jefferies, all banks with the deepest benches in credit structuring and compliance. But the structures involved were non-traditional loans built within the sprawling $1.7 trillion private credit ecosystem, trade finance funds, supply chain financing vehicles, and warehouse lines linked to securitizations. The increasing opacity of these financing structures has led to a corollary collapse in collateral verification. The result is a game of musical chairs in which lenders discover, often much too late, that the same assets were promised to multiple creditors. Herein lies the real story, and it isn't about fraud allegations. Private credit has grown so fast that verification and audit frameworks haven't kept up, leading to structural weaknesses across modern credit markets. Lenders are discovering that their control mechanisms designed for more transparent syndicated markets don't function in opaque financing ecosystem. There's no better leading indicator of market psychology than real-time covenant changes, which show where the smart money is quietly hedging. Right now, the smart money is fortifying against a downturn. Yes, absolutely. So, and again, I think this guy nailed it on his, just kind of description of the private credit market and what is going on with this right now. So,